Hi guys, welcome back to another video on this topic. I'll be sharing is first principles to making money in the financial markets. So I'd just like to use this thinking method to approach this topic, as I don't see this covered anyway, and we're just gonna break down the crucial elements required to make money. Is sometimes some of the elements may actually look very obvious, so let's go into it. So what is first principles thinking? It's an approach that involves breaking down complex problems into their most basic elements and then rebuilding them from the ground up to form new solutions. So an example would be that Tesla uses this for these business models as well. It's just a general approach that Elon Musk has been using for his businesses. Okay, so why I'm doing this is because that I find that it's really hard already to make consistent money from the markets. And if you just take a look around, any funds quoting to have beaten inflation is considered a very good performance. So, and they use so much complex methods that a layman wouldn't understand. And that's fine because they are doing it at a totally different levels to this. But for me, I'm just coming from first principle scientific approach on why or how to just make some green profits from the financial markets. So as we can see, there are many ways to skin the cat and many complicated methods just to make money. In the options trading, we have multi-legged options, and for the big funds, we have hedge fund, exposure to private equity, different funds, and so forth and so on. So let's continue on. So what I've boiled them down, reducing to their fundamentals, is essentially 6 P's and 1 T. So as we can see here, these are in sequential order. We first need to have a preparation of our capital, and then we need to preserve. Then we need to pick the right direction, and there's timing involved. And then it comes to the next P, which is pressing the buy and sell button. Next P is probabilities, and the last P is position closure. So we'll go and elaborate more on these points further. Preparing capital. I think this is an obvious. You need tradable money. It needs to be deposited in a brokerage first before you can even make money from the financial markets. Alright, this just as plain as it is a necessary fundamental that cannot be reduced further. Preserving capital. So once you have the money in your brokerage, right, you need to protect it, because no money makes no money, right? You always ensure that you have the money required to take the next trade. So that involves you using a stop loss for every trade. And then for yourself, when emotion come into play, when you're in a losing trade and you want to get your money back, there's a term called revenge trading, and it's a downward spiral from there on. So you have to stop yourself and have discipline to exact revenge on your trading, so that you can always preserve your capital, because this is about a long-term game rather than a short-term flash in the pan, get rich quick success. Okay, now moving on to the next P is the predicting the correct direction. So here I would like to introduce a concept called liquidity, right? It's an exchange of orders between the buyers and sellers, right? That's what the marketplace is. And somebody is willing to buy and somebody is willing to sell. So I'd like you to think along the line of willing buyers, willing sellers, right? That's what makes the market boom. And you can see that if so, where are the people who are willing to exchange their orders? So where are the market orders resting at, such that it can be easily converted into cash? So I'd like to tell you that suggest to you that it's stop loss orders, because stop loss orders are usually market orders in the brokerage firms that immediately fills when price hits that level, right? So let's talk about willing buyers and sellers, right? If your stop loss is hit, you're willingly letting go your position, right? So people tend to put their stop loss at visually striking places like highs and lows. So I have an example over here that there's a low here, and you can see that there might be people who want to put their stop loss here if they had been long from the way up here. It's just for them to trail their profits. Okay. So this could give us a sense of where the correct direction is. Next, timing. So knowing correct direction is just one part. Now we need to know when to execute, when to buy and sell. I would like to suggest to you here in theory that there are days and hours where the market is more active. Like days towards the end of the week, it becomes more active, like Wednesday, Thursday, Friday. And time, specifically in New York time, like from 8:30 to 11:30, that's the morning, and then the 1:30 to 4 p.m. is the afternoon session. Okay, you might say that the equities market only open at 9:30. That's true, but at 8:30, that's where all the economic news are released, and there is also pre-market trading session, and that's already start. The trading sessions are already active at that point, and they are highly tied to the news factor. As you can see, there are some volatile reactions coming on right at the 8:30 mark when there is high impact news. Next, moving on to high impact news, we see that there are times that is not so favorable for trading because although there's expected volatility, you might not know where it really wants to go. So in order to preserve capital, it's best that you avoid days like such when there is a consumer price index (CPI) or Fed man chair speaking. Yeah, so that increases a lot of uncertainty in the market, and it might not be a very directional and trendy day. So I'd like to invite you to test out what you see, go back to your charts and see if this is true, and you can adopt this as one of the factors in fundamental first principle approach to making money. Next is pressing the button, right? Someone has to be there to click, and you are the one who makes the decision. You own the responsibility, and you need to make yourself available to be pressing the button. Okay, that's simple. Okay, next is about probabilities. So nothing is guaranteed here, as we can see that it's all about being probable or increasing the likelihood of the probability. You can be right in planning your direction, but somehow your trade just didn't go against, just went against you, so you end up on losing end, and you also could do just in the name of stats, and there are things called losing streak. Each time you enter, somehow consecutively you have been acquiring a losing streak, and that's fine because win rates are not that high anyway. For some profitable traders, there some numbers are less than 50% for win rate, so you could expect a few losing streaks before you could actually have one winning one. So next, I would like to suggest that it's not about being right, but being profitable. So when you have entered a position and you are right and you're making money, pay yourself, close out a partial of the position so that you reduce the risk, and then you could also shift your stop to start to trail the profits or even to break even, so that you are in a less risky position than you started off. Last P is about position closure. So here's a point where psychology plays a huge aspect to it, especially greed. Because once we get profits, we think that we can do it again, so we will want to go and have it again. But remember what I mentioned about probabilities. Each time you enter a trade, it's a chance to win or lose, right? So contentment needs to be a key aspect or trait that you need to develop in this. Okay, so one example is that if you lost and or you just wanted to get more profits from a trade that might not hit your desired target levels, and so you want to enter again, and then that will lead you to another trade which you might have lost, and then you might end up in a day with no profit at all, and that makes you want to go on another trade because you're not satisfied with having no profits. So you enter the next trade again and you lost, and then when you lose you get angry, you initiated your revenge trading, and then it all starts to spiral and you might eventually lose all your money. So discipline is a very huge aspect here. So you need to be content. You need to tell yourself that even though I might not hit my target today, it's okay. I just take one trade or as few trades as possible, and then you're done for the day. Okay, you might not be able to capture the whole move. You might not be a pro to do that, but that's okay. At least you took part of it. So you need to tell good things to yourself, that instead of having that voice telling you to oh, you could have gotten more. Yeah, that's great speaking to you. And then next, I'd like to cover that if you just take a little bite out of that whole huge move, you are also you let compounding do the heavy lifting for you. So some math to practice here is that 6% a month is equivalent to 100% a year. That's doubling of your original capital. So yeah, punch the numbers in Excel and you can see that if you consistently perform 6% a month, you actually double your profit, and that's considered very good because beating inflation for the whole year is already phenomenon. And what should I here? I'm just quoting a theoretical number of 100%. So in conclusions, there are 6 P's and 1 T, and are all listed here. So I want to disclaim that these are just the basic requirements in order for you to make money, right? You can add on to this so that you can have more confluence to whatever trading method you are doing. And I just want to say that this is really about first principles approach. These are the bare essentials that are needed. Okay, so anything that you add on to that is up to your own liking, like your fundamental analysis or commitment of traders, etc. So that's the end of this video. I hope you enjoy this content and stay tuned for more. Thank you.